Two men receive the same bank notification. Loan approved, $40,000. Same interest rate. Same repayment plan. Same starting point. One walks out of the bank and signs for a brand new SUV the same afternoon. The other wires the money into an investment account and quietly sets up a small workspace at home. 5 years later, one of them will still be working to escape the loan he already paid off. The other will be using the same loan to build a portfolio worth 6 figures. And the disturbing part, it wasn't luck. It's a Tuesday morning. Two phones buzz at the exact same time. A notification from the bank. Your loan has been approved. Same amount. Same interest rate. Same repayment period. Two people. Two identical financial starting lines. But 10 years from now, one of them will quietly own assets worth hundreds of thousands of dollars, and the other will still be making payments. Not on the original loan, but on the consequences of it. The strange part is that nothing dramatic happens at the beginning. No huge mistakes.
No obvious genius.
Just small decisions that seem almost too boring to matter. Meet Daniel and Marcus. Both are 27 years old. They work at the same logistics company. They earn roughly the same salary, $68,000 a year. They live in the same city, rent similar apartments, and today they both receive approval for a $40,000 personal loan. The terms are straightforward. 7% interest. 5-year repayment period. Monthly payment, about $792. Neither of them is in financial trouble. They simply want to move forward. That phrase means something slightly different to each of them. Marcus celebrates first. He opens a car dealership website that same night. He's been waiting for this moment. A new SUV catches his eye. Leather seats. Large screen. Powerful engine. Price, $39,500. He rationalizes it quickly. Reliable transportation. Professional image. Life is short. Within a week, the loan money becomes a vehicle sitting in his apartment parking lot. The smell of new leather fills the cabin. It feels like progress. Daniel also celebrates. But his purchase is less visible. He spends about $10,000 renovating a small spare room in his apartment. Desk. Lighting. Basic camera equipment. The rest of the money goes somewhere less exciting. An index fund. A boring one. Low fees. Broad market exposure. He doesn't talk about it much. It doesn't smell like leather. It doesn't turn heads in parking lots. Month 1 begins. Both men make the same $792 loan payment. Their bank statements look almost identical, at least on the surface. 6 months later, Marcus drives everywhere. Work. Weekend trips. Late-night food runs. The car feels like freedom. But something else is happening quietly. Cars depreciate. Not slowly. Aggressively. By the end of the first year, the SUV worth $39,500 is now worth around $31,000. That's normal. But Marcus still owes roughly $33,000 on the loan. Without realizing it, he already owes more than the asset is worth. Daniel's investment does something less dramatic. It fluctuates. Up a little. Down a little. Over the first year, the market grows around 8%. His $30,000 becomes about $32,400. Nothing life-changing. Just quiet compounding. Now jump ahead 3 years. Marcus is 30. The SUV still runs perfectly, but it now has 60,000 miles. Market value, roughly $19,000. His loan balance is about $11,000. The math feels like progress. But there's a hidden cost. Insurance. Maintenance. Fuel. Over 3 years, the vehicle quietly absorbs another $11,000. Money that disappears without building anything. Daniel turns 30 as well. His loan payments have been the same $792 each month. But the index fund has continued growing. Markets aren't smooth. Year 2 included a 15% drop. Year 3 rebounded. His investment account now sits around $38,000. Not explosive, but stable. And something interesting happens during those 3 years. Daniel starts a small freelance consulting service using that spare room. It brings in an extra $900 a month. Not every month, but often enough. That money mostly goes straight into the same investment account. 5 years pass. Both loans are fully repaid. On paper, both men are debt-free, but their balance sheets tell very different stories. Marcus is 32. The SUV is now worth about $12,000. He's proud he paid it off. But the car is aging. Maintenance is increasing. New tires. Brake replacements. The idea of upgrading starts creeping in. Dealership ads know exactly when to appear. Daniel is also 32. His loan is gone too. But his investment account now sits around $64,000. Not because the market exploded, but because two forces work together. Compounding and additional contributions. Every month his side income fed the same investment. The machine quietly grew. Now something unexpected happens. The economy slows down. The company both men work for announces layoffs. Marcus loses his job. The SUV is still there, but it doesn't help much. He tries to sell it, but the used car market is saturated. Best offer, $10,500. He hesitates. Without income, he starts relying on credit cards, groceries, utilities, insurance. Interest rates on those cards are around 22%. Debt begins growing again. Not dramatically at first. Just small balances rolling forward. Daniel also loses his job. The same day. Same meeting room. Same HR speech. But Daniel has something Marcus doesn't. Time. His consulting clients still exist. They cover about 40% of his previous salary. More importantly, his investment account has crossed $70,000. He doesn't need to sell it immediately. But the option exists. Liquidity is quiet power. 2 years pass. Marcus finds another job. Slightly lower salary. His credit card balances reached $18,000 during the gap. Minimum payments keep them alive. Interest keeps them growing. Debt feels like a treadmill. Always moving. Never advancing. Daniel's consulting work slowly expands. He never returns to full-time employment. The investment account continues growing. At an average of about 7% annually. Nothing dramatic. Just mathematics. Now jump to age 40. Marcus's financial picture is complicated. His income is stable. But he has replaced 2 vehicles over the decade. Each time using loans. Each time repeating the same logic. Reliable transportation. Professional image. His net worth, after all debts and assets, sits around $18,000. Most of it tied to retirement accounts he rarely checks. Daniel is also 40. His investment portfolio crosses $280,000. Not because he discovered secret strategies, but because he built a system. Borrow once. Invest early. Allow compounding to run longer than most people tolerate. The irony is subtle. Both men used the same financial tool. Debt. Same amount. Same rate. Same 5-year schedule. But the direction of the cash flow changed everything. Marcus used debt to pull consumption forward. Enjoy today. Pay tomorrow. Daniel used debt to accelerate ownership. Buy assets first. Let time handle the rest. Debt itself isn't the villain. It's simply leverage. A tool that magnifies direction. If the money funds something that declines in value, debt amplifies the loss. If it funds something that compounds, debt accelerates growth. Most people assume the big financial gap between people comes from income differences. Often it doesn't. It comes from tiny directional choices made early. Choices that feel harmless. Even reasonable. At the time. The financial system quietly rewards one behavior. Ownership of productive assets. And quietly taxes another. Continuous consumption funded by borrowing. Neither Daniel nor Marcus felt rich or poor at the beginning. Their monthly payments were identical. Their lifestyles looked similar. For years, the difference was almost invisible. Then time did what time always does. It compounded the direction they chose. Not dramatically. Just relentlessly. 10 years after that first loan approval notification, the gap between them isn't just financial. It's psychological. Marcus thinks in terms of payments. Daniel thinks in terms of ownership. One manages obligations. The other manages assets. And the most uncomfortable part of the story is this. At the moment they took the loan, both decisions looked completely reasonable.